If you looked at your portfolio in the last month, you have probably noticed that it is dropping. And you have probably noticed that gas prices are spiking pretty heavily right now, and it feels like just everything overall is more expensive lately, especially because the Fed is not cutting rates, and we have the Iran war driving oil prices higher, and the market is reacting very quickly to this. But the truth here is that this is not just random chaos. So today, I am going to break down exactly what is happening with the economy, what it means for you, your money, and your future. And I want to make sure by the end of this video, you feel confident with what is going on right now and how to optimize your finances here. So before we jump into the video though, go ahead and comment down below. Are you currently worried about the economy right now, or are you just staying calm and investing through it? I really want to see where people's heads are at right now. For me, I am still feeling very calm and investing through it, and I will even talk about that a little bit later. But let us just start out by talking about why is the stock market dropping right now. If you look at the S&P 500 as of today, it is about 8.5% down from its all-time highs, and this has all happened in about a month, maybe a month and a half, and it is basically once the Iran war started, right? And so that is the first reason the stock market is dropping, is because we have geopolitical risk with the Iran war as well as just oil shock in general. And so because of this current conflict, we have completely disrupted just global energy as a whole, especially through the Strait of Hormuz, I believe is how you pronounce it. And so when you see tensions rise near a major shipping choke point, traders are instantly going to price in higher risk and higher energy costs. And whenever we see higher oil costs, this is often going to lead to basically broad price increases across the economy. Because energy feeds into almost every sector from different things, like transportation to production. And oil is actually used in way more things than people realize too. And about 20% of global oil actually moves through that strait. So any threat there causes immediate volatility to different prices and markets. Of course, and investors know that oil is a big inflation driver. When energy costs go up, inflation sticks longer. And we even saw this in 2022, when inflation started to really take off in oil stocks. I am pretty sure was the only sector that did well that year, and it is because of that inflation that we saw then. So that is definitely the first reason why the stock market is dropping. The second reason now is actually because of Fed policy, and because interest rates are a little bit uncertain right now. If you were to ask most people 4, 5, 6 months ago, what is the Fed going to do to rates in 2026? Most people would say that they are going to cut rates, but right now that is kind of remaining unchanged. The Fed is in kind of a weird position right now. And so they are keeping rates unchanged because they are trying to still look at inflation, but they are also trying to factor in this geopolitical uncertainty and how that is going to look for our economy. And so they are leaving rates steady even though inflationary pressures are starting to rise. And this tells us that the Fed is willing to tolerate higher prices for now, but markets interpret that as just a lack of direction. And so that is another reason that they are selling off. They do not like that lack of direction. And they love when the Fed cuts rates. And if you do not know how the Federal Reserve works with interest rates, let me just give you a little macroeconomic lesson from what I remember in college. Basically, the Fed wants our economy to do well, and they do not want inflation to be high. So if inflation goes up, what the Federal Reserve does is they increase interest rates, and they increase interest rates indirectly by increasing something called the federal funds rate. It is basically the rate at which banks loan money to each other. If banks loan money to each other at a higher rate, then they will pass higher interest rates on to the consumer, so they kind of do it indirectly. This is called counter-cyclical policy. And so the Fed is in a weird position though right now, because if inflation starts rising, then they may have to actually increase rates. Right now, it is not rising rapidly, but they are keeping a close eye on it before they were slowly cutting rates the past year and a half. Because we saw inflation going down, but if it starts to pick up pretty badly, then they are going to have to increase rates. And because the stock market now thinks that rate cuts might not happen at all this year, it is going to push yields higher and make stocks, specifically growth stocks, a lot less attractive. And you are even seeing this with a lot of big tech companies. I mean, even a company like Microsoft is trading down, I think, 30% or around there from their all-time highs in that, so that is the second reason why the stock market is dropping. Now, another reason is because of higher borrowing costs and yields. So due to the war and inflation expectations, the U.S. Treasury yields have climbed. So that is another reason why the stock market is dropping. Now, the third reason here is because of higher borrowing costs and yields. So due to the war and inflation expectations, U.S. Treasury yields have climbed, which this will then reflect basically increased borrowing costs across the economy. And so when you have higher yields, this means that investors, they are going to demand more return to compensate for risk. So then what they do is they pull money out of risky assets, like stocks, and they put more money into safer ones, like bonds. And so the 10-year yield increases also pressure sectors that rely on cheap capital. These are like your tech and your growth stocks that you are seeing get killed right now, and higher interest rates make future earnings less valuable when discounted back to today, meaning stocks need to get stronger to justify their valuations. And so those are the main reasons why the stock market is dropping. Now, I do want to briefly talk about my fear for what could potentially happen. But before I do that, I want to reiterate, I am not trying to fearmonger you guys, because I am going to talk about towards the end of this video, what can you actually do to, take advantage of everything that is happening right now. So my actual fear that I think could possibly happen is what happened in the 1970s. And this is something called stagflation. And so stagflation is the combination of slow economic growth plus high inflation plus high unemployment. And in the 1970s, we actually saw oil price shocks drive up costs across the economy, while weak productivity and poor policy response basically froze growth. And so real wages fell even as prices rose. And so this is a nightmare scenario for most people, and it makes sense why. I mean, things are going up in price, but wages are not going up to account for these higher prices, and the economy is slowing down. And we do actually see a couple of parallels to this today, because right now we have rising energy prices. We have inflationary pressure that has not fully eased. We have a Fed that is very hesitant to cut rates, and then we have consumer sentiment that has been sliding. And this is a thing people have been saying for a while now. I mean, inflation continues to grow, but wages are not following that. And so it makes it harder and harder for the everyday person to get by. And then another parallel we do see is a lot of stock market volatility. So it is a very familiar thing to that 1970s basically energy as well as like policy mix that we saw. But there are a couple of big differences that I still want to point out and acknowledge. And we are not necessarily doomed, but I will say yes. Right now, it is kind of seeming like we are going to go into a stagflation type economy. But one of the key differences is that the US economy is a lot less dependent on oil today than it was in the 1970s. And we are actually a lot bigger oil producer now, and we are not as reliant on imports, although we still absolutely do import oil. And then another thing here is that inflation, it is not at really extreme levels yet. Like it is, I think it is starting to go up a little bit, which is the whole reason the Fed is hesitant to cut rates, because they do not want to see it skyrocket, but it is not at extreme levels yet. So still, even if energy stays elevated and the Fed does not pivot, inflation could become sticky, which drives prices up without the growth to actually match it. And so why do markets hate stagflation? Well, it makes perfect sense why. Because when you have high inflation, your real returns basically are eroded. Like if you get a 12% return in the market, but inflation is 6% because it is pretty high, then your real return is only 6%. Like you have to factor in inflation when looking at your total returns. And then on top of this, you are going to have slow growth in the economy, which means that earnings could stagnate or potentially, start to look pretty ugly. And so if you combine those two things, then stocks just offer a lot less upside while the valuations of a lot of huge companies start to shrink and get a lot smaller. And that is why we are seeing our markets start to sell off in response to basically everything that is going on. And so I do fear us going into a stagflation environment. But again, inflation is not there yet. That is just something that I want you guys to know about and at least be aware of, because it could happen. But your next question is probably, well, what can I actually do about this? The first thing I would say is make sure that you have a very solid emergency fund. I am talking 3 to 6 months of your monthly expenses. And I know I say this in a lot of videos, but when the economy is uncertain, that is one of the best times to have a solid emergency fund. That way, if something goes bad, then you do not have to stress about it. So that is the first thing I would say. The next thing I would say is to actually focus on fundamentals. Do not just read headlines. Like markets always are going to go up and go down, and there are geopolitical tensions that will always make headlines a lot worse than reality is. So try to keep your perspective on things. And also remember that a short-term volatility that we are seeing, that does not mean that we are going into a long-term collapse. Because kind of like what we saw last year with the tariff situation, I think the market sold off like 15, 17, might have been even like 18% in like a month or two, and then it completely bounced back. And the same thing could be happening right now. Again, the market is only down about 8.5% from its all-time highs. We are not in full on bear market territory where we are down 20-25, 30%. So I do not think there is any need to freak out, but we should look at this Warren Buffett quote that I love right here. Alright, I am just kidding. Of course, Warren Buffett would never say that. That is such a funny picture that I saw online, so I had to plug that somewhere. But I do want to reiterate that, even if the market does continue to drop for the next 6 months, 8 months, maybe even 2 years, the only thing you need to focus on is making sure that you have income coming in and you can pay your bills. And if you can invest money on the side, this is where the opportunity is going to really, kick in. Because what you want to do is you want to stay invested, but make sure you are at least somewhat diversified. So that is why I always invest into index funds. I am not entirely focused on one single sector of the market. You could own things like VO, which are the 500 largest companies in the US. You could own VTI, which is basically the total US stock market. So you get the large companies plus the medium and the small companies, and you could pair VTI or VO up with VXUS, which is an international ETF. So you are not only exposed to US markets, and if you want to just own every stock, you could also own VT. Now, this is not financial advice. This is just a good way to stay diversified. That way all of your money is not just in a couple of tech stocks and you are just YOLOing it, just hoping things bounce back. Because if you are not just betting on one sector, then having that diversification, it is going to help you a lot big time. Especially if we see certain sectors start to do really well. For example, like energy. If there is high inflation, then you are going to see oil stocks go up pretty big. And I am pretty sure we have already seen that with ExxonMobil and Chevron, year to date. Not saying to go buy these companies, but, certain sectors may do bad, like technology, but other ones may do really well. And you are also going to probably see consumer staples, as well as just more defensive sectors, start to hold up pretty well. And so making sure that you have a lot of different sectors in your portfolio is really important. That is why you want to be diversified. And that is the beauty of just owning ETFs. You do not even have to think about it. You can just keep investing consistently. And a lot of the times people tend to think in themes, but they do not actually think in timelines. Investors are the most common thing for the everyday person is to basically just buy when the market is doing well, and they sell when the market is doing bad. And that is the complete opposite of what you want to do. I follow the Money Guy Show method, and that is to always be buying. I have been buying last month, I am still buying this month, and I am going to keep buying next month. And when you see the market dip like this is actually an opportunity to be buying things on a discount. It is a good thing, especially if you are bullish on the entire economy or even just the US economy, which I am. I think we will always, whether the market drops 20% or 40% or 5%, I think we will always bounce back and continue to grow. And so do not try to sit there and time the market, just keep investing consistently. That is what I am doing. I have already maxed out my Roth IRA this year. I am going to be focusing on the brokerage. I am still throwing money into the 401k, just stay consistent, and this will definitely pay off, especially if you have a long time horizon. I am talking 15, 20, 30 plus years. And so that is one thing you definitely want to do. And then on top of this, try to position yourself for inflation. But make sure you keep a little bit of risk in check because inflation can actually be hedged indirectly through different assets, like real assets. I am talking things like real estate, or if you own dividend-paying stocks, or if you own inflation-protected bonds. I am not saying to sit here and just gamble and take, huge bets on random things. But just having exposure to a lot of different things is going to help you with inflation. And so this is how the everyday person could take advantage of this. Now there is a lot of opportunity that is provided in tough times because when the market drops, we are getting lower valuations, which are lower entry points. If you are investing into VO at $600 a share and you thought it was a great ETF, you should be excited if VO goes to 500 or 400 because now your $1,000 investment is going further than it was before. You are buying more shares and you are buying the exact same thing you were buying before. You are buying the 500 largest companies that did not change at all. And when you see these corrections or you see the market do bad, this is going to reset valuation. And that means that long-term investors, they are going to be buying in at lower prices, which is definitely going to benefit when the market starts to stabilize and bounce back. And so lower valuations are a great thing in my opinion. That is why I do not stress the stock market doing good or doing bad, because if it does good, then great. I am making money, and if it does not, then that is fine. I am just going to keep buying and I am going to be lowering my average cost per share. I am buying things on a discount and I am confident that things will bounce back. Even if it is not 3 months from now, even if it takes a couple of years. I am okay with that because time is on my side. And so another reason that we can see a lot of opportunity is that we see something called sector rotation. And so when you have inflationary pressures as well as uncertainty, we can see, energy stocks and materials often outperform those big tech companies that we have been seeing. You can also see utility stocks and different staples just holding steady. And so there are different sectors that are going to outperform other ones. And this could give you a chance to actually buy some really good tech stocks if you do invest into individual stocks. Or a more tech-focused ETF, which is what I do with VUG. You can be buying that on a dip, which is a pretty good move as well, especially if you are still bullish on them long term. And so the main takeaways here is that we are in a pretty weird environment. Let us just call it how it is. We are not at 100% stagflation yet, but risks are definitely higher than they have been the past few years. And when we have geopolitical risk, as well as rising costs and the Federal Reserve being cautious, this is going to create a lot of volatility. But remember, do not panic. Take a deep breath. Everything is going to be okay. The economy is not collapsing. Markets swing with emotions just as much as they do with data. So just be aware of that. Markets can be very emotional. And last thing you can do is just position yourself wisely. Like, make sure you are diversifying. Make sure you are staying invested long term. You are not panic selling. And just make sure you have a pretty solid emergency fund and your savings are built up. And if you need to try to educate yourself on how these macroeconomic conditions could affect your portfolio in your life. So that is what is going on in our economy right now. I hope you guys enjoyed the video. If you did, drop a like down below, hit that subscribe button. I will see you in the next one. Peace. I have always believed that the best time to build wealth is when everyone else is looking for the exit. It is easy to be an investor when the charts are all green and everyone is making money on random coins or speculative tech. But the real wealth, the kind that changes your family's future for generations, is built during the boring times and the scary times. It is built when you continue your monthly contribution even though your account balance is lower than it was 30 days ago. That is where the discipline kicks in. That is where the math starts to work in your favor. Think about the people who stayed the course in 2008 or 2020 at the time. It felt like the world was ending. The news was constant doom and gloom. But those who kept buying the index, who kept their jobs and kept their heads down, are the ones who saw 5x or 10x returns over the next decade. We are in one of those test periods right now. The market is testing your resolve. It is testing whether you actually believe in the long-term growth of the economy, or if you were just here for the quick wins. I am here for the long haul. I am looking at 2040 and 2050, not just next Tuesday. And when you change your perspective like that, the daily fluctuations start to feel like noise. They are just blips on a much larger radar, so keep your head up. Focus on what you can control your spending, increase your income, and stay consistent with your investments. The macro stuff is interesting, and it is important to understand, but it should not dictate your daily actions. Your daily actions should be dictated by your long-term goals. I am excited for what the future holds because I know that those of us who stay disciplined now are going to be in a very different position in 5 years. We are going to be the ones who bought when things were on sale. We are going to be the ones who did not let fear make our decisions for us. And that is a very powerful place to be. If you have questions about specific ETFs or how to set up your emergency fund, check out my previous videos where I dive into the nitty-gritty of those topics. I want to make sure you have all the tools you need to succeed, because when one of us wins, we all win. This community is about lifting each other up and sharing the truth about money without the fluff. So stay tuned for more updates as the situation evolves. I will be here tracking the data and sharing my thoughts with you every step of the way we are in this together. Let us keep building that freedom. Let us keep pushing forward. No matter what the headlines say, your future is in your hands. Make it a great one. I am going to go check the latest treasury yields now, but I will be back soon with another deep dive. Take care, stay smart, stay invested, and most importantly, stay focused on the life you want to build. I will catch you guys in the next one. Peace out. The world is full of distractions, but your financial goals are yours alone. Do not let the noise drown out your strategy. Trust the process, trust the math, and trust yourself. You have got this. See ya.